What is going on, Future Focus Nation? My name is George and I talk about finance and investing in this channel. And today I want to talk to you about a company that I'm very excited about. The name of this company is PaySafe. And this company will be going public through a special purpose acquisition company merger, ticker symbol BFT, in Q1 of 2021. So sometime soon. Now, this company is not a hidden gem. However, at the current price, I still think this stock has a lot of room to grow. So today we're going to talk about who the leadership of PaySafe is. We're going to talk about William Foley and his role in this special purpose acquisition company. We're going to talk about the good and bad of PaySafe. And then ultimately, we're going to end it with my strategy going forward. Before we get into all of that, invest in yourself and press that like button. Invest in me and smash that subscribe button. With all that said, let's get into it. Whenever I invest in a company, I like to know who their CEO is and who their CFO is. And the reason for it is that this is like the brainchild of the company. The chief financial officer plays a big role in the money of the company, what they're doing, how they're making money, and how they can save money. So it's very important. And ultimately, the CEO, he's the leader of this company. You know, he's the one who's the driving force behind which path the company takes. Now, Philip McHugh, he's not new to this space. He has over 25 years experience and 11 years of that experience coming with Barclays, who's a well-known financial conglomerate. Now, Ismail Dawood, he has 25 years of experience as well, and 14 years of that has been spent in a range of finance and corporate leadership roles at Wells Fargo, as you know, a leading financial services company. So they have two great people who are leading this company. Now, what do? They provide businesses of all sizes with the tools and support they need to scale, grow, and convert more customers, whether it's for online or in-store card acceptance, secure cross-border payments, mobile points of sale, or streamlined online checkouts. Hundreds of thousands of customers have plugged into PaySafe and our global payment network. When I was doing my research on this company, one thing that I liked was that this company has a sticky customer base. What that means is that customers use this company and reuse it and use it over and over, which is good. You like to see that reoccurring revenue. PaySafe is specialized across multiple industries, which is something I like to see. And you'll see later the way they diversify, but they have manufacturing, retail, e-commerce, wholesale distribution, government and municipalities, medical equipment, and healthcare, which is something that's going to be big under the new current administration. So they are active in 120 global markets with over 70 different payment methods. PaySafe helps you accept payments from customers simply and securely, however they want to pay. So it gives you optionality, which is something that's outstanding. Here are the proprietary integrated solutions. So proprietary means that they own it. They have ownership of this. So they have global stored value digital wallets. And this is done through two companies that they have under their umbrella. We'll talk about those later on. They're into iGaming. And as you know, we saw 2020, we witnessed a huge growth in iGaming, and they already have their foot in here. And they have a PaySafe integrated processing, which is how they process payments, whether it's through iGaming or they have a digital card as well that you can use online or physically at a bunch of different locations. They work with Visa, they work with MasterCard, which is always something you want to see. This is how they diversify, like we talked about. So they diversify through processing, wallets, and eCash. That's the segments that they're in. Their geography, they're 38% in Europe, 48% in North America, and 14% in the rest of the world. So they don't have all of their eggs in one basket, which is always great. And then finally, this is how they're diversified vertically through iGaming, SMB, and emerging verticals. This is the brands that they have underneath them. So Income Access is basically a brand that helps with marketing strategies, and it helps customers that have like e-commerce, like it could be small people, small businesses like you, like me, that are selling things online. They help you market your brand in order to scale it and make it bigger. So that's one thing. PaySafe card, like we talked about, you can make payments, whether it be online or offline. NetTeller and Skrill are probably their two biggest companies that they have underneath their umbrella. And these companies are both like digitalized wallets. However, they're both kind of different. NetTeller even deals with cryptocurrency. Their petroleum card services is just a way of companies, whether big or small, in order to pay for fuel. As you can see, they're very diversified within their own brand. William Foley, He's the founder of the special purpose acquisition company, which is going to be coming public. This is a little bit about him. He has a long history of value creation, over 32 years of history in making companies grow. As you can see on the right-hand side, he has Fidelity, which he helped grow. Fizz is another company that he went into kind of like this one, and you can see the growth there. So he's a home run hitter. He's been hitting home runs out the park. Through F&F, Foley was able to acquire and spin out Fizz, current market capitalization out to 91 billion. You can see what he's bringing to the table. One thing that I do like is that he has a lot of positive recognition in the market. So Bill Foley is an agent of change and transformation, and you can see the plan that they have here. And whenever you invest in a company, you like to see planning. You want to know what their future holds. This company right here, they have a total project cost savings from platform integration. So they have total revenue growth strategies, winning in US iGaming, and their merger and acquisition strategy. And this is one of the reasons that I feel that they're going public to begin with. They have a plan to purchase and merge with a lot of other companies. I think more acquisitions than mergers, but that's something I would look forward to. As soon as this company goes public, I could see them buying a company that didn't do so well during the global pandemic and that is struggling. So look out for that. PaySafe is a compelling investment opportunity. They have scale, they have high margins, strong cash conversion, and strong growth. And this is just me speculating, but I could see PaySafe taking a big dive into cryptocurrency just because of the markets that they're trying to reach. So this is me speculating, nothing I've heard, nothing I've read, but I could see them making a big dive into cryptocurrency. It just makes sense. So as you can see here, PaySafe, they're leading in 5 sectors. And of course, these are sectors that they chose. So take this with a grain of salt. However, in these 5 areas, PaySafe is leading PayPal, who is not a competitor, but they're kind of like in the same market. They're not direct competitors. We'll take a look at their direct competitors shortly. I told you I would show you the bad. And as you take a look here, the Proforma Ownership, this just means the ownership before the merger occurs, 45.7 goes to Blackstone and CVC. Now, one of the things that people don't really understand with special purpose acquisition companies is that you have PIPE investors, and then you also have investors that have a lockup period for their shares. All this means is that they have to hold their shares for a certain amount of time before they have to sell it. Now, companies like Blackstone, they really don't hold equities too long. They get their gains and then they sell. That's how they make a lot of their money. So this is one of the cons that I see. Once their lockup period comes due, I could see them selling a majority of their shares in order to reinvest that into other investments and keep growing. That's how companies like Blackstone make their money. So that is one of the fears that I have going forward, that there's going to be a big drop. However, I am still optimistic about this company. And as you can see here, Blackstone owns 45.7% along with CVC and some other shareholders, and the PIPE shareholders are about 27.8%. Foley Trasimene owns about 4.0%. Now here's their direct competitors. And this was something that I looked at and I thought to myself, all right, you have some actual companies that you may not have heard of, but they have a larger revenue than PaySafe does currently. So currently WorldPlay is their #1 competitor, and they have about 4.1 billion. You can see these companies are a little bit bigger as they have a larger amount of employees, except for Stripe. But you could see here that, there is competitors in this space. I started purchasing around $10 per share. I've also purchased when it dropped from around $14.50 to around under $14. I purchased another 100 shares. What you see here at the end is a double top, which is usually a bearish signal. So I wouldn't be surprised to see it drop to about $15 per share, or maybe underneath $15 per share. But honestly, I think that's a buying opportunity. Within 2021, I could see this company going to $45, $50. It wouldn't surprise me if this company hit that. Looking at the bottom of this screen, you could see that the volume for this company has remained stagnant. It's dropped and dropped and dropped. Currently, all that means is that people are waiting for the actual merger to occur. Once that occurs, I wouldn't be surprised to see some profit taking. But again, ultimately, by the end of the year, I see this stock 2xing or 3xing. Now, again, one of the big things we have to pay attention to is once that lockup period comes, what is Blackstone going to do? Are they going to sell? Are they going to buy more shares? I really don't see them buying more shares. What I could see them doing is selling a portion of their equity and keeping some just in case the company keeps going up, growing and growing the way we're predicting that it will. This will be a big catalyst. If they sell, it may cause a big sell-off. But again, take this as a buying opportunity. If that happens, the potential for this company to grow is huge. Again, my name is George. Remember, I am not a financial advisor. I am just simply giving you some tools for your toolbox. Do your own research. But I do want to know what you plan on doing. Do you plan on buying this? Do you already own it? Let me know down in the comments below. Remember, invest in yourself. Hit that subscribe button. Invest in me and press that like button. Until next time.